Stock futures right now pointing to a lower open. Joining us now in the markets and what to watch in the new year, Jay Woods, Freedom Capital Markets Chief Global Strategist. Jay, great to have you with us.
Great to be here.
You think we're at the beginning of a 10% correction? Why?
I do. I'm unfortunately calling for something like that, but we've had a tremendous run. 10% corrections do happen on average every 18 months. And what we're seeing is just horrible market breadth. The leadership, great leadership, those Mag 7 names, but the divergence is getting a little too rich for me. And I think once we get to the new quarter, we're going to have some headwinds to deal with, and we may see some of those Mag 7 names give back a little bit. And I don't think the rotation will keep up enough to prevent us from having a correction back to the 200-day moving average, just above 5,500. To me, when you live through it, it's not going to be fun. But the setup right now, given that, and then the uncertainty coming in with the new administration, tariffs, possible unemployment ticking up with this, Elon Musk and Ramaswamy's deal. So Doge, that was the name I couldn't think of. So there are a lot of questions coming into this, and tariffs are going to come back to us. They're going to hurt the bottom line. So that uncertainty could lead to a little trepidation, and we get a normal correction. I don't think it's that big of a call given what we've done over the last 2 years.
Under that macro backdrop, though, does the Mag 7 look more defensive? And so, therefore, the Mag 7 could actually hold up relative to the other parts of the market. I mean, we've already seen this. The divergence that you cited has existed for the entire length of 2024 so far. So why at this point is it troubling, and why wouldn't the Mag 7 be defensive? Well,
the Mag 7 was the story in 2023. It started off well in 24. Then the rotation happened. We saw every sector lead at different points. Energy led, materials led. Sure. Materials is just awful right now. But right now, the leadership is starting to wane a little bit. And I think a pullback in some of these names could be great buying opportunities. You look at Apple, all-time new highs, Amazon, Google breaking out. I think the stories are there. But right now, it's just one of these situations where we're tired. We saw it in the beginning of the third quarter in July, where they stopped going up. NVIDIA has struggled to get back to those highs. A lot of those names stalled. Tesla stalled for a long time. Tesla's a little different, its own little animal right now. But overall, these stocks, they can go neutral for a little while, pull back naturally, still be great buying opportunities, especially Amazon, Alphabet, and Apple.
What happens to some of the so-called defensive sectors in this kind of environment where things are so uncertain? Do they actually become defensive? Because I mean, utilities aside, because that's sort of an AI play, power generation story that's gotten a whole other boost to it, but a healthcare, a staples, these sorts of sectors.
Well, the healthcare and the staples have been beaten up. You may get a little bit of a mean reversion there. I don't know if it's the safety trade. Watch in the earnings, especially with the staples, when they talk about Forex, seeing how strong the dollar's been. That is going to be something that's going to be brought up again and again and again. Utilities, yes, I think that would be a safe haven to go to, and there's more of a story there. They're not your grandparents' utilities anymore. They're not there for the safe dividend. But I think the strength is still going to be in that AI story, but the AI story has changed. It's not, hey, what's the hype, what's the CapEx? It's what has that CapEx done? How are you utilizing it? And where's the growth going to be? Salesforce was the perfect example. You look at Salesforce, what they came out with their agent force. They're adding 2,000 jobs in the AI program. We have stories. If you were to look at one sector, the software sector, the ETF there, you have ServiceNow looking phenomenal. Microsoft still a stalwart. Palo Alto Networks
so the
also
handoff
in that.
Software
is the handoff. Software. How we utilize AI is going to be where it is. And any pullback in anything that's software related, especially the leadership there that you see in the ETF, to me, that's going to be the opportunity. I still think over the course of the year, we're going to be up 12 to 15%. Close around 6,900. But
12 to 15% in 2025, because that would
from
be
where we are right now,
a remarkable, couple-year run. I mean, really unheard of, historic run.
Well, this is a secular bull market. My overall thesis has not changed. But during these bull markets, you do have normal corrections. We didn't see it in Trump 1.0. 2017, we were up every month of the first year of the Trump administration. No day with a 2% drawdown, not one. We rode the 50-day moving average, only closed below it 17 times, touched the 100-day once, and then continued up slow and steady. I don't think we're going to get a repeat of Trump 1.0 in the first year, because tariffs are going to be an issue. Tariffs are what derailed us in the beginning of 2018. And if we come out of the gates firing with tariffs, people are going to be shocked. And the market hasn't had a little bit of that shock, that uncertainty in quite some time. October 23, the last official 10% correction. So to see it pull back to its 200-day moving average, still secular bull market, think a great buying opportunity. And I think the rest of the year will be set up really strong. But to come on and say, yes, I think the next 6 to 8 weeks could be rough, it's not usually how I look at things. I think the big term, the big picture, this will be an opportunity. And when we go through something like this, this change, it could be a little nerve-wracking, but the opportunities will present themselves. And then we need to get back to seeing these other sectors, like you mentioned, healthcare. Let's see where we go with the RFK administration, if that even comes to fruition, and what happens there. But overall, technology still where you want to be in financials. Financials look fantastic. There's a great tailwind there. M&A activity will pick up. I think the regional banks, you may see some mergers there. We haven't seen a lot of, necessary merge. We've seen people come because they need each other in the regional sector. We haven't seen an acquisition to try to grow, and I think we'll start to see that as the year picks up as well.
What is the Fed backdrop?
The Fed backdrop, that's the one. The Fed, that last meeting, but usually Jerome Powell, stalwart, it was a 50-50 whether or not they should have cut. They did cut. We had a second dissension, different dissenter this time. So the Fed is kind of at this tipping point where they're not certain what the path is going to be. 2 cuts, okay, that sounds fine. But just watch the 10-year. The 10-year is the tell. We're up 100 bips since the low when we started to cut rates. And now if we get to that high, which I believe was in April or March or April of 4.7%, we're looking at possibly a run at 5%, and I think that is another headwind that this market faces. The fact that the 10-year continues to slowly tick higher in the face of all this, it will eventually have a little bit of an impact on the stock market. The fact that it hasn't yet is kind of telling as well.
So we crossed 4.7 in your forecast for a 10 to 12, 15% rise.
I think that will be the accelerant. That'll be the accelerant for a 10% correction. The tariff uncertainty.
And would it be a cap on your forecast for the year if we were at 4.7%? Yeah,
well, I think once we get a little turmoil in this market, that will change the tune in Washington. And we'll probably, the market is a report card for this incoming president, and, we'll see what happens. But right now, there is a lot of uncertainty. Even at the Fed, the way they speak, they don't seem to be on the same page. It was shown in the dissent, the dot plot. Okay, not as aggressive on the way down. And then tariffs lead to inflation. Unemployment could rise. So there are a lot of X factors that I think could lead into a little uncertainty. And we saw that in the beginning of the third quarter when those Mag 7 names did take a hit. And, what held up? Small caps. Small caps aren't going to hold up in this environment this time around. I hope I'm wrong, but I think the next 6 to 8 weeks could be a little problematic, but set us up for a great last 3 quarters of the year, that's for sure.